Welcome to the deep dive. So it's May 10th, 2025 as we're recording, and well, inflation is definitely something on my mind. I bet it's on yours too.
Absolutely.
Seeing that rate around 3.6% back in March here in Japan, you just, feel it chipping away at savings.
It's a real worry, no doubt. And
Yeah.
that's exactly why we're digging into this today for you.
Yeah.
Our goal really is to lay out some, let's say, solid ways you might be able to shield your money from that pressure.
Yeah.
We've sifted through the info to focus on what seems most relevant right now.
Good. Yeah, we're going to zero in on, I think, three main things that popped out from the sources. First, Japanese government inflation-protected bonds, JGBi. Then Japanese real estate investment trusts, J-REITs.
The familiar ones.
And finally, the old standby gold. We should probably also quickly mention why, regular savings accounts might not be cutting it anymore.
Right, definitely worth touching on.
Okay, so let's get into it. Starting with what sounds like the safest bet, those Japanese government inflation-protected bonds. JGBi. For anyone not totally up to speed, what exactly are these? How do they work?
Okay, so JGBi, basically, they're bonds from the Japanese government. But the key difference is the initial amount you invest, the principal, it isn't fixed. No, it actually adjusts based on the consumer price index. Specifically the index that excludes fresh food prices.
Right, the core inflation measure, basically. So if
Prices go up.
Exactly. If the cost of living rises, the principal value of your bond is designed to go up too.
Okay, so it's directly linked to inflation that we're seeing day to day. How does that play out for someone holding the bond?
Well, inflation goes up, the principal value gets adjusted higher, and what's really interesting, especially for the bonds issued after 2013, is this thing called a deflation floor.
A deflation floor.
Yeah, it's like a safety net.
Yeah.
It means even if Japan hit a deflationary period where prices actually fall, the value of those newer bonds won't drop below what you originally paid for them. Ah, okay. That's a significant protection.
It is. And on top of that, you get interest payments twice a year. These payments are calculated on that adjusted principal amount, which could be higher because of inflation.
That sounds, well, pretty secure. So if someone listening is thinking, okay, maybe I want some of these, how do they buy them? Is it complex?
No, not really.
Oh.
It's actually quite accessible for individual investors. You can buy JGB through the usual places, securities firms, banks.
Right.
You don't have to get involved in the big government auctions or anything like that.
Simple enough.
Yeah. And for the absolute latest details, especially on the 10-year ones, the Ministry of Finance website is always the best place to check.
Okay, so easy to get, they move with inflation. What are the main upsides, the pros of JGB right now?
Well, the biggest advantage, especially if safety is your top priority, is the government guarantee. That means they're considered very, very safe.
Right, government-backed.
And second, as we said, they directly respond to inflation, which helps protect your purchasing power. Plus, that deflation floor adds another layer of comfort. It's interesting. Even though the yields might seem low compared to other things,
Yeah.
in an environment where inflation is kind of sticky, but maybe the economy isn't booming, these JGBD could actually give you a better real return after inflation than traditional bonds.
That makes sense. So safety is the big draw. What's the catch? What are the downsides?
The main trade-off is the return potential. The yields on JGB are typically lower than what you might get from riskier investments.
Okay.
And their growth potential is pretty limited, especially if inflation stays low or drops. They're really built for preserving value, being conservative, not for chasing big gains.
Understood. Safety first, lower growth potential. Okay, let's pivot. Let's talk about something maybe aiming for a bit more growth, though obviously with different risks. J-REITs. Can you give us the quick lowdown? What are J-REITs?
Sure. J-REITs, Japanese real estate investment trusts. You can think of them like companies listed on the Tokyo Stock Exchange.
Okay.
They pool money from lots of investors, and then they use that money to buy and manage properties. Could be offices, apartments, shopping centers, warehouses, you name it.
Right, a whole portfolio of properties.
Exactly. And the income comes mainly from the rent collected on those properties, plus maybe some profit if they sell properties for more than they paid. That income then gets passed back to the investors, mostly as dividends.
Okay, so it's a way to get into the real estate market without, buying a whole building yourself. How does this help with inflation, though? What's the link?
The link is mostly through the rent. When general prices are rising with inflation, landlords can usually increase rents over time.
Ah, okay.
So as rents go up, the J-REIT potentially collects more income, and that can lead to higher dividend payouts for you, the investor. Also, the actual value of the properties that J-REIT owns might also increase in value during inflationary periods.
That makes sense. Rents go up, income potentially goes up.
Yeah, and it's worth noting different types of J-REITs might react differently. Like residential REITs, apartments might see steadier rent increases. Commercial or office REITs could be more tied to how the overall economy is doing.
Interesting distinction. So what's the market looking like for J-REITs now in 2025? Any forecasts?
Well, the sources we looked at suggest a range for the Tokyo Stock Exchange REIT Index, maybe somewhere between 1,500 and 1,900 points for 2025. But, and this is important, the market is pretty sensitive to what happens with U.S. long-term interest rates.
Always connected, aren't we?
Seems that way. On the plus side, the dividend yield looked quite attractive. There were forecasts for over 5% back around December 2024. And the trend seems to be towards dividends generally increasing.
Over 5% yield potential is definitely eye-catching. How do people actually invest? Just buy them like stocks?
Pretty much, yeah. You can buy shares in individual J-REITs you like the look of, or you could go for a broader REIT index fund. You just do it through your regular securities broker.
And you can choose sectors, like focus on offices or logistics or whatever.
Exactly. You have that flexibility to target areas you think have potential.
Okay, so the upside is potentially rising income and maybe asset value growth thanks to inflation pushing up rents. What are the risks we need to watch out for?
The main ones are market risk. Just like stocks, their prices can go up and down based on investor sentiment and interest rate risk. If interest rates rise sharply, that can make borrowing more expensive for REITs and potentially make their yields less attractive compared to bonds, which could hurt their share price.
Right, and economic downturns probably hit real estate too.
Definitely. If the economy struggles, vacancy rates can rise, rent growth can slow, and property values might fall. So more potential reward than JGBi, but also clearly more risk.
Okay, that's clear. Bonds for safety, REITs for potential growth and income. Let's move to the third one, gold. It feels like gold always comes up when we talk inflation. Still relevant in 2025.
Oh, absolutely. Gold's reputation as an inflation hedge goes back, well, centuries. And yes, the general expectation is that it will continue to play that role. It's often seen as a sort of safe haven asset people turn to when things feel uncertain or other assets are volatile.
Right.
And, while it doesn't pay interest, its historical performance against monetary inflation, I think governments printing money is something people really pay attention to, especially given, well, recent global trends.
Okay, so the thinking is it holds its value. How do you actually invest in gold? It's not like buying shares.
Well, there are a few main ways. You can buy physical gold, bars, coins.
Right, like in the movie.
Yeah. But then you need to think about storing it safely, maybe insurance. That's a hassle for some.
Sure.
A much more common way these days is through gold ETFs, exchange-traded funds. These are funds listed on the stock exchange, like the SPDR gold shares here in Tokyo, ticker 1326. They basically track the price of gold. Much easier to buy and sell.
Okay, ETFs sound more practical. Any other ways?
Yeah, some banks and financial institutions offer gold savings accounts. These let you buy small amounts of gold regularly, like contributing a bit each month.
Got it. So what's the core argument for gold as that inflation shield?
Fundamentally, it's that gold tends to hold its purchasing power over the very long term, especially when currencies lose value due to inflation. It's also seen as a good diversifier for a portfolio because its price doesn't always move in sync with stocks or bonds.
Okay, diversification, value preservation, what are the downsides then? The risks?
The main one is price volatility. While it might preserve value long term, gold prices can swing quite a bit in the short term, so it's not a guaranteed smooth ride.
Right, not a straight line up.
Exactly. And the other key thing is, unlike J-REITs or even bonds, gold doesn't pay you anything while you hold it. No dividends, no interest. Your entire return depends on the price going up.
Okay, so purely about price appreciation and maybe peace of mind. Now, I think our sources mentioned a couple other things briefly, other investment ideas floating around.
Yeah, just quickly, dividend growth stocks came up. The idea being companies that consistently raise dividends might help you keep up with inflation, but, that carries significant stock market risk.
A higher risk, yeah.
Foreign currency deposits were mentioned too. Could work. The yen weakens, but then you've got exchange rate risk going against you, potentially. Very unpredictable.
True.
And commodities, things like oil, agriculture, their prices often rise with inflation, but wow, they can be incredibly volatile. Not for the faint of heart.
Okay, so other options exist, but maybe with more specific risks or volatility. Now, there was also some chatter mentioned on X, I think, about using tax cuts to fight inflation.
Ah, yes, that
Yeah.
came up. Different viewpoints there. Some people were suggesting, maybe counterintuitively, that cutting the consumption tax could actually increase inflation short term.
Interesting theory.
Others were proposing temporary cuts to, say, taxes and social insurance premiums
Yeah,
as maybe a quicker way to give households relief.
right. Lots of debate.
Exactly. But honestly, for you, the listener, trying to base your personal investment plan on guessing future government policy changes, that's probably not the most solid foundation.
Yeah, good point. Focus on what you can control.
Right, your own strategy.
Okay, so let's try and wrap this up. We've looked at JGB, the safety option, J-REIT's potential for growth and income, gold diversification, and maybe that long-term value store. What's the big picture takeaway for someone worried about that 3.6% inflation number?
I think the most critical thing to grasp is that standard savings accounts, even with rates maybe creeping up slightly, you mentioned maybe 0.22% generally, perhaps some one-year deposits hitting over 1%.
Yeah, around there as of May.
Right. Those rates are just very unlikely to match 3.6% inflation. So while your savings account is vital for your emergency cash, for money you need quick access to, it's probably losing purchasing power over time in this environment.
It's safe, it's liquid, but it's not really growing against inflation.
Precisely. It's not the tool for long-term inflation protection, generally speaking.
So what's the final piece of advice for someone listening and weighing these options?
Look, finance is complex, and everyone's situation is unique. Your goals, how much risk you're comfortable with, your time horizon. So the smartest move really is to talk this over with a qualified financial advisor.
Get personalized advice.
Exactly. They can help you figure out what mix, if any, of things like JGB, J-REITs, gold, or maybe other strategies entirely makes sense specifically for you.
Sound advice. Tailored strategy is key. Okay, before we finish, maybe a final thought for you to mull over. Considering these different approaches, we discussed the safety of bonds, the potential growth in REITs, the diversification of gold. What single factor, be it safety, growth, or maybe diversification, feels most important to you personally in the current economic climate, and why? Something to think about as you plan your next steps. Thanks for joining us for this deep dive.